Welcome back to the deep dive. Most people see markets. They see prices going up, prices going down. Maybe you think supply and demand like a simple ledger.
Yeah, like it's static.
Exactly.
Right.
But our sources today, they paint this much more dynamic picture, almost aggressive, like a constant auction. Buyers, sellers, always negotiating, sometimes really fighting it out.
That's absolutely the core idea we need to grasp today. So the mission for this deep dive, give you a fast, practical understanding of auction market theory, AMT, and the main tool we use to see it, the volume profile chart.
Okay.
If you're trying to, really understand market structure, this is it. We're keeping it pre-focused today, aiming for that quick, usable insight.
Right. So the goal is finding the market's fair value, that equilibrium point.
Yes.
But doing it by looking at where the actual trading happened, the volume.
Exactly. Volume tells the real story. It's the footprint of agreement.
Okay, so let's start with the engine behind it all, this continuous auction idea, AMD.
All right. So auction market theory, fundamentally, it just views the market as this non-stop auction, always happening. Every trade matches one buyer, one seller, always.
But here's the key distinction one source made, which I think is critical.
Yeah.
Price doesn't move because, suddenly there are tons more buyers than sellers.
Yeah.
It's impossible, right? One-to-one.
Always one-to-one.
Price moves because one side gets aggressive, really steps up. Buyers start bidding higher, or sellers start asking lower. That's the driver.
Aggression is the fuel. That's a great way to put it. Buyers get aggressive, they lift the offer, price goes up. Sellers get aggressive, they hit the bid, price goes down. And this means the market is always sort of cycling between balance and imbalance.
Balance being when things are calm. Aggressive buying, aggressive selling, they're roughly equal.
Yeah, that suggests the market's found a temporary comfort zone, a fair value range where people are happy to trade back and forth. Inventory feels about right.
But then imbalance kicks in.
Right. One side just takes over. They need to trade, maybe urgently, so they push the price hard. And that push, that's price discovery.
So the market's actively searching, moving away from that comfortable spot to find new people willing to trade at these new, maybe higher, maybe lower prices.
Precisely. It's a negotiation in motion.
Okay, theory makes sense. Continuous negotiation. Now, how do we actually see this? That brings us to the map, right? The volume profile chart.
Exactly. So section 2, visualizing the auction. Volume profile is different. Normal charts put volume bars at the bottom based on time.
Yeah, the usual histogram down there.
Volume profile turns it sideways. It plots the total volume traded horizontally right next to each specific price level. Basically a histogram on its side showing volume at price.
Okay, so you instantly see where the action was heaviest.
That's it. You see where the market spent its time, where the most agreement happened. Big horizontal bar, lots of agreement, market acceptance. Thin bar, price shot through there, rejection.
Okay, visually maps the negotiation intensity. And you mentioned there are key landmarks on this map we need to look for.
Yeah, the big three we're focusing on today for this quick overview. First, the point of control POC. Second, the value area VA. And third, the surrounding peaks and valleys, high volume and low volume nodes, HVNs and LVNs.
Got it. All right, section 3, let's nail down that first one. The absolute center, point of control, POC.
The POC, it's simple. The single price level, just one pick, that had the absolute highest trading volume for whatever period you're looking at, like the highest peak on that sideways histogram.
So literally the price where the most business got done, the most agreed upon price.
Yep. That's why we call it the fairest price for that session. It's like the market center of gravity. Price tends to get pulled back towards the POC. It's a key reference.
Okay, and then around that peak, you have the value area, the VA.
Right. The value area, or VA, is the price range where the real bulk of the trading happened. The standard definition, and what most platforms use, is the range that captures about 70% of the total sessions volume, usually centered around that POC.
70%. So the core zone of agreement, what does that tell us practically?
Well, it gives you context immediately. If the price is currently trading inside that value area, that suggests we're in a balanced market, maybe a rotational day.
Things are calm, back and forth.
Pretty much. Business as usual. Traders are comfortable within that range. It often sets up potential trades, fading the edges of the VA, expecting price to stay contained.
But, and this seems like the important part, what about when price moves outside the value area?
Yeah. That's a big signal. It means the market's likely become imbalanced. It's actively searching, doing that price discovery thing we talked about.
Because those prices outside the VA are seen as unfair temporarily, since 70% of the volume didn't happen there.
Exactly. There wasn't broad agreement out there. So when price breaks out, you often see faster moves. Either it finds a new value area quickly, or it snaps back into the old comfortable VA. It's a sign of change.
Okay, that makes sense. We've got the accepted zone, the POC, and VA. Now, what about those other peaks and valleys? The nodes, section 4.
Right, the HVNs and LVNs. Think of them as like the terrain features around the main peak. They give the profile its shape and tell us more about the journey price took.
So high-volume nodes first. HVNs, these are smaller peaks, right?
Yeah.
Not the POC, but still significant volume.
Correct. Secondary areas where a lot of trading occurred. They represent other spots where the market found some level of agreement or acceptance, just not as much as the POC.
And practically, what do they do?
Well, HVNs often act like magnets or maybe speed bumps because a lot of people traded there if price moves away and then comes back to revisit that HVN level.
Ah, support or resistance.
Exactly. Strong support or resistance. Think about it. Lots of people might have entered positions there. If price comes back, those who are maybe underwater on their trade might use it as a chance to get out near break even.
Trapped trader.
Yeah, trapped inventory is a big part of it. That buying or selling pressure at the HVN can cause the price to slow down, hesitate, or even reverse. They're reliable reference points.
Okay. And the opposite. Low volume nodes.
Yeah.
LVNs. The thin spots.
The gaps, the troughs, these are price levels where very little trading happened. The market basically sliced right through them. It signifies strong rejection.
So if HVNs are speed bumps, LVNs are highways.
That's a perfect analogy because so few people traded there. There's very little resting interest, very little liquidity. They're like market vacuums.
Yeah, the effect.
Price tends to move through LVNs very quickly. It can accelerate or even seem to jump across them because there's just no friction, no volume there to stop it. Great for identifying potential targets during strong trends.
Got it. HVN magnets, LVN vacuums. Okay, theory, map, landmarks. Let's get practical. Section 5. How do traders actually use this stuff, say, trading ES or NQ futures?
Okay, yeah. So futures traders, especially day traders, look at the volume profile for each session. They'll mark out the POC and the value area for the current day as it develops. But crucially, they compare it to yesterday's profile.
Ah, the context matters. How does today relate to yesterday's value?
Massively. Let's run a quick scenario. Say the S&P E-mini, the ES, opens inside yesterday's value area. What does that suggest?
Balance. The market's kind of accepting yesterday's prices still.
Exactly. High probability of a rotational balanced day. Traders might look for price to move between yesterday's VA high and VA low, maybe using those levels for entries or exits, expecting chop.
Okay, but what if it gaps open way outside yesterday's VA, like opens much higher?
Big signal. That shouts imbalance. Active price discovery is happening right from the open. If, say, the NASDAQ, the NQ, gaps up above yesterday's VA and starts building volume higher, creating a new POC up there that confirms strong buying interest.
So the market's searching for and maybe finding a new, higher fair value.
That's the interpretation. It suggests a potential trending day, looking for continuation in the direction of the gap.
Now, you mentioned profile shape earlier. Like P or B, how does that fit in?
Right. The shape tells a story, too. If the profile is mostly balanced, it looks like a bell curve, a D shape, POC in the middle. That's your typical rotational day.
Okay.
But if the market trends hard up all day and then consolidates near the highs, the profile looks like a P. Most volume, the belly of the P, is near the top. That might suggest exhaustion or distribution starting.
And a B shape is the opposite. Trend down, consolidate low.
Yep, high volume near the bottom, like the belly of a B. Could be absorption or short covering near the lows. Analyzing these shapes gives clues about conviction and potential reversals or continuation for the next day.
Okay, and bringing back those nodes.
Yes.
Say there was a big HVN on the NQ from a few days ago at, 18,000. If price is trending down towards 18,000 now, that old HVN is likely support.
Very likely. It's a prior area of strong agreement. Buyers might step in again, trap sellers might cover. But if it breaks 18,000 decisively,
Then that support failed, the trap guys are flushed out, and maybe it accelerates down to the next low volume node.
you got it. That's exactly how traders use these levels dynamically. It's all about context. AMT and volume profile give you that context. It helps you see past the noise, understand the market's intention, where it's comfortable, where it's trapped, and where it's actively searching.
Okay, fantastic. Let's wrap this up and just quickly recap the core takeaways for everyone listening.
Yeah.
4 key pieces.
All right. First, auction market theory. Markets in auction, driven by aggression, always cycling balance and imbalance, searching for value.
A second, volume profile. That's our visual map. It shows the point of control, POC, the single price with the most agreement, the fairest value.
Third, the value area, the VA. that 70% volume zone. Inside is balance, comfort. Outside, that's active price discovery, imbalance, things are happening.
And fourth, the nodes. HVNs are magnets, acceptance, support resistance, often with trapped traders.
Yeah.
LVNs are vacuums, rejection, fast move zones.
And putting it all together, understanding the profile shape, the relation to prior value gives you a solid framework. You're making decisions based on where real high volume agreement actually occurred. That's powerful.
Definitely gives structure. Okay, final thought for you to chew on. We talked mostly about daily profiles. But what happens if you zoom out? Imagine stacking, say, 50 days or even a year's worth of volume data into one massive composite volume profile. If daily HVNs act as support, what kind of influence might those huge long-term value areas and POCs from that composite profile have? Could they be showing us the major multi-year boundaries that even the biggest institutions respect? That's thinking about structure on a whole different scale.